we assume you have a well-built, diversified portfolio, the risk to you is that the stock market comes down and at the same time you need money.
Absolutely.
It's
And I
not that
think,
the stock market comes down and stays down for the rest of your life. It's not that it goes to zero and you have to go back to work. It's that it comes down, you have to sell at a loss, and there's a multiplying effect to that.
You're listening to Advised with Rick Lucchini.
How you ought to be invested during retirement and how that might be different and how that might be similar to how you should be invested pre-retirement. Because
okay.
I think that a lot of people get that wrong.
Yeah.
There's a lot of old rules of thumb that may or may not apply in
Yeah.
today's world. And so let's maybe just start there and see where it goes.
I like it. I think that's a great place to start. I think, and you tell me risk, Rick, but there I go. I'm talking about risk already. I think like, am I being too nerdy by saying this? I think the first thing that you have to make a really important distinction is, and this is one thing that a lot of firms and advisors, I think kind of drop the ball on, is like differentiating between like, what's your risk tolerance and what's your risk capacity? Like how much risk do
Yeah.
you want to take on and how much
Yeah.
risk can you and ought you take on?
Yeah.
Because I don't know, like a lot of times the experience with a new financial advisor, you go see them, here's a risk tolerance questionnaire. Tell me how much up and down you want in your portfolio.
Yep.
And then I'll just sell you on, well, here's the investments that do that.
Yeah.
Whereas, I've had cases, and I know you have too, where somebody will say, hey, I want a very, very low risk investment,
Yeah.
but I need a lot of cash flow and I need my money to grow for the future. And it's like, well,
Yeah.
there's a big disconnect there, right? And so,
I get very sensitive about that because I feel very strongly about it. And the way I view it is this: there's a way to be invested for your situation.
yeah,
I have a pretty good understanding of what that should be, plus or minus 10%. And I don't really care
sure.
how you feel about it. Here's the proper way to do it. Now, where the risk tolerance comes in is education. So I'll
Yeah.
still do that same risk tolerance questionnaire and I'll say, boy, we're on the same page. Let's skip all this junk and move forward. Or there's a big gap between how you feel and
Yep.
how I think you should feel. And then that just leads me down the path of how much education I need to give you to make you feel comfortable with having the right portfolio.
Yep.
But I think it's a big mistake, whether you're retired or whether you're still working, to be invested based on how you feel.
Yeah. That's a
It
great point. I
really
mean,
just doesn't make any sense. What the concept is behind that is a big company will say, tell me how you feel. We'll invest you that way. So then you never call and bother us.
yeah.
And then we have time to go find more people to do the same thing with. Whereas in a real plan, when you're working with an advisor, if you start to get uncomfortable, it's their job to keep you on track instead
100%.
of you feeling good about it.
How much risk you should take on as a math problem, how much risk you want to take on as a psychology problem. And
Correct.
the goal ideally is to marry the two of them so that they are the same. Because
Yeah.
I mean, what people don't think about is, I mean, you're really your number one risk, one of your number one, probably top risks in retirement is running out of money.
Yeah.
And inflation's not going to slow down because your risk preference is low. So you have to, I mean, and I've talked about this with you before, Rick. I'm 33 years old at the time of this podcast recording. Everybody would understand I need to invest a lot in high growth investments for my retirement in my 60s. But a retiree, somebody who's retiring now at 60, has the same time span till
Yeah.
their 90s, which a lot more people are living to. I've had clients who've made it into their late 90s. I've had a couple that have made it to 100.
Yeah.
And if your money's not growing for your 90-year-old self, you might feel really good now at your low risk diet,
Yeah.
but it's kind of like making a whole meal out of mashed potatoes. It feels really good, but it's not going to give you what you
Yeah.
need to be healthy 20 or 30 years down the road if you do nothing but eat mashed potatoes every day. So I think getting your risk right is huge.
So let's cap that with just getting a little understanding of how do I know how much risk I should be taking? Let's say I was I listen to this and I say, okay, I'm going to leave my emotions out of it. How do I know how much risk I should be taking? How do you quantify that for a client, and then give them the recommendation?
You know, I like to actually start with cash flow. So
Yeah.
cash flow to me is what drives how much risk you should take. So if you look at, I'm going to butcher these statistics a little bit, but if you look at the the level of risk that the biggest 500 companies in America have had over a long time frame, from like the 1950s to now, which is kind of like what I would consider like the modern America, right?
Yeah.
A good market, sometimes they call it a bull market, is on average 100 months long and it grows about 428%. A
Yeah.
bad market is about 12 months long on average and has a decline of 35%. So if you're going to invest in stocks and to grow long term, that is a great solution for, hey, I need my money to grow for my 70s and 80s and 90s, but you have to consider, okay, what is my cash flow for the periods of time when it's not going to be up, because
Yeah.
I've got to solve for how do I keep myself from getting into a situation where I'm selling my stocks when they've lost money and now I'm just basically bleeding out of my portfolio.
Yeah.
So we start with cash flow, really looking at what are your spending needs, not just your bare necessities. What are your income sources? How many of those are guaranteed versus not guaranteed income sources? And then we really start by building a bucket of money that is going to be outside of the stock market that usually represents between 5 to 7 years worth of spending. And that might be a little bit, some people might hear that and think it's not enough. Some people might think it's too little. But
Yeah.
usually, if you're in that 5 to 7 year range of having something that's outside of the stock market, whether that's bonds or money market, CDs, whatever, some combination of them, that's going to give you a really good buffer so that when, not if, but when the market goes down and when your long-term growth investments go down, you've got something that can maintain your quality of life and that will give you peace of mind to allow your long-term money to come back up. So we think in
Okay.
terms of kind of time frame and cash flow for when money's going to be used to start getting investments right. How do you handle it? Something similar?
Well, it's interesting that you brought up cash flow because it seems like we can't have a topic or talk about a topic without the answer being cash flow. It's
That's
just,
right.
I mean, seriously, it's like it all comes back to that. And we do start there. I don't really have like a rule of thumb as this is the amount of months or anything that we're setting aside. And I think it's interesting you said like non stock assets. Are you doing that? Let's say you said 5 years, which to me seems like a really long time, but I'm more aggressive than you
Sure.
are.
Sure.
We've talked about that. There's no right or wrong. It's just the way it is. Are you doing that all in one portfolio? Are you just basically saying like, if 30% of their portfolio is the 5 years, then I'm giving them a 70-30 stock to bond ratio? Or are you literally like bucketing them out and saying, here's this cash CD ladder reserve in this other account that we can pull from, and then I just have an all stock account? How are you actually putting
Yeah,
that into
that's a great
practice?
question. I actually really do like to take kind of the family's money approach versus the individual account approach.
Yeah.
So like for families who we're in January when we're recording this, we have families who did Roth conversions in December, and that money's stuff that they're not going to be touching for quite a while. So that stuff might be invested in all growth long term. And when I talk long term with my clients, I'm thinking 5 plus years out. So
Yeah.
that stuff might be more aggressive. And then we might make a game plan to say, okay, over the next few years, we're going to be taking your income from a combination of your IRA and your taxable brokerage account plus your other fixed income sources. And so we're going to make sure that in that IRA and that brokerage account, to keep it at, right where we want you to be for taxes, those are going to have your war chest of cash, bonds, CDs, and other asset classes that are going to
Right.
be more insulated from the stock market. But yeah, we are going to have
Okay.
some accounts that are going to be all equity, even for
Yeah.
a 70, 80-year-old client, because it's
Yeah.
tied to when are they going to need these funds, and
Yeah.
and why would I put bonds in there to drag their performance if we're not planning on touching them for 20 years and we don't need to touch them for 20 years.
Okay. And it's interesting that you said that, because while you were talking and I was kind of dozing off and like doing some mental math, no offense, but I
Fair
was
enough.
like, okay, when you say 5 years, that seems extreme to me. but it's 25, like assume that they're
Yeah.
doing like a 5%, which is 25%. You're still a 75% equity portfolio, which I
Yeah.
think a lot of retirees is going to think is very aggressive.
Yeah.
And so I think maybe we're thinking about it slightly different, but I don't think we're investing significantly differently.
No.
When you think about that, a 5% withdrawal rate is just on an average, and we don't do a flat withdrawal rate like that, but just on average,
Sure.
5 years is 25%. You've got 25% in bonds, CDs, and some combination of cash or treasuries, and 75% in stocks, right?
Yep.
Is that,
Plus or minus. I'm probably more like 30-35% in fixed income. I'm probably closer to the
Okay.
7-year mark. And then I'm also counting in, that cash flow should be hopefully going up every couple of years. And that's
Yeah.
also the advantage too of if you do a good bucketing strategy or however, a war chest, whatever you want to call it, is that over time, your income should be growing as your investments grow
Yeah.
and your investments earn a increase. Your paycheck should be earning a pay increase more often than not. Definitely there'll be times where you
Yeah.
might have to tighten your belt a little bit, but generally speaking, over the long haul, you should be getting your income growing over time to kind of go
Right.
lockstep with what's happening to everything you have to buy, right?
So to tie that back to risk and risk capacity, what that really means is this: I'm taking two different sets of risk,
Sure.
right? My risk, let's say this: the risk to you, if you're invested, we're just gonna assume that you have a well-built, diversified portfolio. Because if you're holding shit, you're gonna have shit. Like, that's just the way it is, right? If we assume you have a well-built, diversified portfolio, the risk to you is that the stock market comes down, and at the same time, you need money.
Absolutely.
It's
And I
not that
think
the stock market comes down and stays down for the rest of your life. It's not that it goes to zero and you have to go back to work. It's that it comes down, you have to sell at a loss, and there's a multiplying effect to that. So if we take that risk away
Yep.
by saying these dollars are not going to be needed for 3 years, 5 years, 8 years, whatever it is,
Yep.
there's no real immediate risk right there. And then the dollars that you're going to use in the 2, 3, 5, and 7 year mark have a lower probability of fluctuating and causing you that concern. So when people look at a 70-30 portfolio or having 80% in stocks, if it's built correctly, you don't have a whole lot of risk to your income when you're actually not taking any income from those dollars.
Yeah, defining risk is important, although it might be the epitome of the most boring topic we've talked about even. But to your point, when we talk about risk, I'm not talking about, hey, let's throw something at the wall and see if it sticks.
Right.
This is a great new meme coin that came out. It's Dogecoin 6.0. This one could go to the moon, or the rug could get pulled. Like, I don't believe that kind of risk is ever appropriate to take with a retiree's portfolio. I don't even take it with my own portfolio at 33 years old. But even then, I'd say in other asset classes, I have clients who have rental properties, and that's part of their retirement income. And a few couples that do Airbnbs short term that are getting into them, I would consider their Airbnb income to be riskier because they are newer to being Airbnb hosts. They're in a new area. And so do we want to have a retirement plan as new landlords that counts on, hey, we have to have 80% capacity on our Airbnb or our rental properties? Right. No, I want that to be fun spending money for them. And I want their safe money to come from their Social Security, their pensions, any annuities that they have, and a good, sustainable long-term withdrawal strategy that would have worked in a 2008 or 2000 or 2020, where you have a long period of declines in your growth investments. So yeah, risk sometimes can be even traditional asset classes like real estate can have risk that could be something you have to factor in, especially if the landlord's kind of newer at being a rental investor, right?
Yeah. So if I'm not retired yet, okay, let's say I want to split the difference between you and me, and I want to be 75 in stocks and 25 in bonds or some equivalent in my first year of retirement, for all the reasons we just said. how soon should I start moving that way as I get closer to, because I'm still working, right? I'm
Yeah.
still working. I'm still putting money away, and I listen to Rick talk, and I'm at 100% stocks,
Sure.
and I'm getting paid for it, and it's working. When should I start shaving some of that back to get closer to the actual year one retirement strategy and overall target portfolio?
I think some of that will depend on the person. I think you could start as early as 10 years out or no later than 5 years out. I think 5 years is more my preference,
Yeah.
because 10 years is a whole decade of, if you're shaving off a lot of money that could continue
Lost
to grow.
opportunity. Yeah.
Yeah, big lost opportunity. However, there have been 10-year periods where stocks have had a negative return over 10 years, from 1999ish to 2009 is a notable example where, US stocks didn't do as well over that time period. So I think some of that
Yeah.
comes down to the couple and making sure that, looking at their other income sources as well. If somebody has really low Social Security, no pension, they don't have any other
Yeah.
guaranteed sources of income, maybe you might want to start a little bit sooner, especially if there's a good chance they're going to live really long, or they're going to retire really, really early, like in their 50s, like early 50s. But otherwise, I'd say, 5 years out is probably a pretty good time to look at checking on your investment strategy and maybe starting to make some tweaks to get ready for
Yeah.
day one. Is that kind
And
of
I
what you would
think
do?
I mean, again, I'm probably a little shorter than that because I'm just a little bit more aggressive. But I think unfortunately, what we see a lot of is we're getting the client in that last 24 months,
Yeah.
12 months. Sometimes I retired yesterday, and we're not given the opportunity to plan that out, unfortunately, because they're not starting early enough. I think in recent history, we haven't had too many bear markets that have lasted more than 18 months.
Yeah.
So I'm comfortable with, like, hey, let's start easing towards that final target in the last like 2 to 3 years.
Sure.
Knowing that the more stocks I have, because even in that first year, it's all prorated. That first year, I'm not taking 25%. That's 5 years worth. I'm only taking 5.
Yeah.
So as long as I have some dollars in that bucket, that gives me even another year in my first year of retirement for the market to recover, to replenish that. That's kind of the way I look at it. It's a little bit more of an aggressive approach, but I think you should be allowed to make money whether you're retired, whether you're old. Like, if the stock market goes up 15% in 1 year, why does it matter how old you are? You should be able to participate in at least a portion of that.
Sure.
And so I think, to cap that off, some of the old rules of thumb and what your parents likely told you, and they did, not you, but the listeners, is be ultra conservative as you approach retirement, because you're going to need that money. You can't afford it to go down. And there were some reasons for that. Your parents and grandparents' retirement savings was not as big as yours. They had a pension, they had Social Security, and they had this small little bucket of money on the side that they could not afford to see it go down because they would have nothing.
I think
yours
too,
yours needs to support your income and grow with inflation and all those. It's like a whole different world now.
Yep.
And that old school walk into retirement with zero debt and ultra conservative investments often makes you lose money safely, but you're still losing money.
Yeah. I think too, you have a lot of investors who, especially like my clients, who either lost money, a lot of money themselves in 2008 for a long period of time, or they know somebody who did, who is just getting ready to retire. They've all heard the stories. They've seen the TikTok reel of somebody selling something who, oh, my cousin lost all his funds in 2008. I actually have a client who had stocks who literally went to zero in 2008. And I think that's where it's important to make a distinction, that if you have an overly aggressive investment strategy, or an overly active strategy, especially if it's one where I would say like
Speculative.
you're speculative. That's a great word. Thank you. If you're being very speculative, which in my mind is I'm banking on individual stocks. I have $1 million portfolio and I'm picking, 10, 12 or 5 or whatever individual stocks. And these are the companies that I think are going to do the best. You're probably taking on a lot more risk owning. This is something that is somewhat of a matter of opinion because there's thousands of stocks. So you could pick the right 5 and I'd be wrong. But you're introducing the need to make a lot of decisions, and the more decisions we have to make, the more we have a chance to mess up. I love how like I think a lot of investment portfolios should be like Steve Jobs' shirts, right? Like Steve Jobs wore the same shirt all the time, everywhere he went, and that'll reduce the need to make decisions all the time. And I think that the more you can simplify your investments, the better chance you have at success. And truthfully, the stories where people did lose tons and tons of money in 2008 and 2009, like a lot of times I think they were probably taking on a lot more risk than they knew they were. And they were being their advisor or them were being a lot more speculative, and they weren't prepared for a down market, because no retirement plan should depend on the market being rational, whatever that is, right? The market is not rational. It can be irrational a lot longer than we can be liquid if we're not prepared. So I think some people are gun shy, and it's more of a result of not just how much risk were they taking on, but what were the other factors that went into why they were taking that much risk, and the decisions that they had to make that probably weren't made that should have been beforehand. It's like trying to build a roof on your house during a rainstorm, right? You don't do that. You try to be prepared before those things happen.
Let's touch real quick about, you said about the market being rational. I don't know the answer to this. It's been something that I've been dealing with a while myself, and has recently led me to be more, we shouldn't say aggressive. It's more stock weighted in the portfolios, even for my retirees. And the question is, are bonds doing what bonds are supposed to do, which is protecting our portfolio in these down markets? And the reason I say that is there's a lot of examples recently where that's not the case. And so
basically yours and my entire career of bear markets has been like bonds are bad. They're just not as bad in a bear market. It's how it's felt, especially if you had bond funds. And especially if you had actively managed bond funds a lot of times.
Right. So here's the thing. If a bond doesn't protect me in the way it did when the market was more correlated 20 years ago.
Sure.
But it also doesn't earn as much when everything's good. Why am I holding them? And definitely why am I holding a lot of them is the question I keep replaying. I don't know for sure. I do a lot of math that I try not to make the outcome be what I want it to be, but let's just look at that for a second. What did bonds do recently? They tanked because something that no one really predicted, which was the Fed artificially increasing interest rates. Did that help by a lot? Did that help your portfolio at all? Absolutely not. So the person that said, "Dear advisor, I'm super conservative. I filled this thing out and I want to take no risk." He said, "Cool, here's 100% bond portfolio." They lost a ton of money.
Yes.
And it's not going to recover quickly because they're holding bonds that no one's going to want for 10 years at 3%.
Imagine how jaded you would be as an investor if you sold out at the bottom of COVID, bought a bunch of bond funds, and then turned around in 2022 and just saw those tank some more. Like you would probably, okay, this whole game is rigged and it's against me. Right. No, I think you're right. I think right now, and this is tactical and this will change probably over time. I do think when it comes to investment strategies, being boring with stocks is great. And I think sometimes being a little more active with bonds, there's a little more room there because, I mean, if you think about it, Ford Motor Company, I don't know if they have preferred stock or not, but I know they have like maybe 1 or 2 individual stock classes. They probably have dozens of bond issuances. And I think the bond market's a little less efficient. And so I personally have enjoyed over the past year with interest rates being what they are, doing more individual bond holdings instead of buying stuff in a fund where that fund has daily liquidity. So it's going up and down in price, where we
Yeah.
have laddered out CDs between, 12 to 24 months for clients. And we still actually use a good bit of bond funds between, stuff that has short maturities and long maturities because of the liquidity factor. But we've also just enjoyed the fact that, hey, I could make 5.5% on a CD in my portfolio for a while. It's come down a good bit for sure. But let's take, if we have 40% or 30% of our money outside of the stock market, let's maybe take half of that and let's ladder out some other products, some CDs and some money market, and just take the risk of the fund value changing over time out. Because we get, with a CD, you get your par value. You put in $1,000, you hold it to maturity, you get your $1,000 plus interest. I don't know how great the CD environment is going to be going forward as rates come down, but it's been a good way of, I would say, taking out the risk that you have a run of bad luck, which is, the run of bad luck is, your stocks are down and your bond portfolio is down. And then you're on the phone with your advisor and he doesn't really know what to say.
Well, I think it's just worth mentioning that it's okay to challenge what the old way of doing things has been, because we're not in the 70s and the 80s. Like, things, the world economy has changed. Information has changed. Daily trading and computer trading has changed all of this. And a 5% pullback is not something that a client is going to get worked up about or is going to affect your retirement or your income. It's the 30% and the 25%. Okay. And in recent history, what's been happening is, when those big market drops happen, it's because of an event. It's not that it's slowly going down and the correlated bonds are going up and like buffering that. It's an event where everyone runs the cash or gold or stuff sit on their mattress like COVID, and bonds are plummeting too, because all that information is out there. And if stocks and bonds go down at the same time, it didn't really protect you from that short-term volatility. But then when stocks pop back up and bonds stay down, I'm just not a huge fan. I've got them, but I've been shaving the weight of them. And when correlations change and I feel better about it, maybe everybody will be holding a 60-40 in 2 years. I don't know. I don't commit to like, this is what I believe forever. But right now, I'm more comfortable having my clients overweight what you might think a retiree is in stocks, rather than holding these bonds with unknown interest rate manipulation and what I believe has just been a news-stricken market drops. This event happened, everything goes down at the same time, but when they're running to safety, the dollars are coming out of bonds too, because they're in funds, and that's what's happening. So
Absolutely.
I don't know how I feel about it long term. I just know that if you are retired or you're close to retirement, you still need to own stocks.
100%.
And there's a way to do it that really takes what you perceive as risk off the table. And still have what's important to you, which is liquidity and a down market strategy, by bucketing some other money.
Because at the end of the day, it comes down to the two big risks. There are plenty of them, but the two big risks that most retirees face, especially early in retirement when they're figuring out how much they can withdraw, they risk the fact that they could live a lot longer than they planned for. I know, sounds horrible, right? They could live a lot longer than they planned for. And so you solve for that by owning things that are going to grow, hopefully faster than inflation. And the other risk is they really risk the fact that they could be getting on a roller coaster in the middle of the loop-de-loop, right? They could have a run of bad luck where the day one they retire is the beginning of, I tell my clients, it's, hey, the UFO invasion of 2025, right? The unknown, unknowable thing happens, and you start off there. You can't just start by cashing out all your things that have lost money. So you manage that run of bad luck by owning something that's not behaving the same way your stocks are. even if it's a drag, whether that's CD ladders, bonds, cash, whatever.
Yeah.
But between those two, honestly, that cures a lot of ills. If you just get your cash flow right and
right.
solve for the math on both of those, and then make it like Steve Jobs' sweater, make it as boring and as easy to manage as possible. So that way you can prevent yourself from having to make a ton of decisions in the middle of a crisis, because that's not the time to make decisions.
I think the big takeaway is to have it evaluated and to look at what we're calling a portfolio, when I do it, is the entire household. So I'm sorry, but the $100,000 that you're hiding in the bank, I count that
part of your portfolio
towards your 30% conservative side of your portfolio. I don't care where it's at. I don't have to be managing it. I count it. I count your real estate assets as a certain asset. Like, you count the whole portfolio. So if you want to hide stuff or have CDs or do this other stuff going on, that's great. The portfolio I'm managing might be 100% stocks to offset that.
Yep.
Whereas somebody that I have everything, they might have 30 or 40% cash and bonds because they don't have other liquid things at the bank. So you need to look at it as a whole household and manage it appropriately. And one last thought around that and the idea of risk is we deal with this a lot because we both run Guardrail Income for our clients, but just a concept is it's okay. Like, your plan is able to adjust. So a lot of people will say, well, if this happens, then they're going to have to sell at a loss and all. Like, okay, if that perfect storm happens, you know what I tell my clients? Can you take 2 vacations this year instead of 3? Or can you not go to Europe for 9 months? You know what I mean? Like, and they're like, yes. And then next year they're back on track. But what they got for making that one-time adjustment was spending significantly more money over their lifetime and earning significantly more money. Or, like, we're humans. You're allowed to say, if all those bad things happen all at once in the perfect storm, I will make a short-term adjustment. But if all those bad things don't happen, I'm going to have a hell of a lot more money throughout my lifetime.
Sure. Absolutely. And knowing what kind of adjustments you'd have to make, knowing, hey, how much money would I actually have to lose before I had to tweak my income? And how much would I have to cut my income? And as long as that's acceptable, and I think too, there's something to be said for having a lot of your expenses, your living expenses, your just bare necessities covered by guaranteed sources. I don't think there's anything wrong with that, whether that's Social Security, pension, or if you bought an annuity. If you have, a third of what you're spending or more plus or minus covered by something that's not tied to the stock market, plus you have a good strategy in place to manage a run of bad luck, then what you're really talking about, hey, if I have to tweak and reduce my spending for a short period of time to let my stocks recover, you're talking about maybe taking a 5 or 10% cut on your discretionary spending, right?
Right.
More often than not.
Not forever. For 12 months, for 18 months, maybe. And
but
then
the trade-off,
you're right back to spending more than you would have your whole entire life.
That's exactly it. The trade-off is people hear that and they think, oh, I don't want to tighten my belt. I never want to have to reduce my spending. And it's like, okay, well, let me tell you, you don't have to ever reduce your spending. Just start spending less right now. Right. So the trade-off is if you want to maximize your cash flow today, you have to make a deal with yourself that you're going to take on some risk, that you're going to also have a plan for a run of bad luck. And you're also going to have to say, hey, if I'm going to spend every single dollar I can now, which is what most retirees want to do because they're active from 60 to 70, they're running and gunning, they're going places, then they have to make a deal with themselves and say, if not when stocks decline, if they were to decline by this much, I'll reduce my spending by 10, 15%, whatever it is, to allow them to get through. But that makes it sustainable so that you can spend as much as possible and so that your cash flow can grow steadily over time and support your retirement.
Let's leave it there because we're starting to talk about guardrails and nobody knows what that is. So we're gonna have our own episode about that because it's super sexy and fun to talk about. So stay tuned for episode on guardrails. That's how to spend money the right way in retirement. And we're gonna leave it there, buddy. Thanks.
I like it. Good talk, man.